Imagine waking up, grabbing your phone, and seeing a notification from your bank. It isn't a deposit. It isn't a withdrawal you made. It is a correction. You log in, and a percentage of your savings is gone. Beside the deduction, there's a legal term you have never seen before: bail-in recapitalization. This is not a hacker. This is not a glitch. This is the law. While you were sleeping, the consequences of the JP Morgan default we covered yesterday finally hit the consumer level. The banking cartel has moved from bailouts, printing money, to bail-ins, taking your money. The wall between the bank's debts and your life savings has just been breached. To understand how they can legally take your money, you have to understand the lie you have been told your entire life. You believe that when you put money in a bank, it is yours, sitting in a vault for safekeeping. That is legally false. Under US and UK law, once you deposit cash, it becomes the property of the bank. You become an unsecured creditor. You hold an IOU. You have loaned your money to the bank. And yesterday, the bank admitted it cannot pay you back. In a bankruptcy court, unsecured creditors are the last to be paid. They are legally allowed to use your funds to pay off their derivatives debts before they give you a single penny back. Critics will say, this can't happen in America. They are wrong. It is written in black and white in the Dodd-Frank Act of 2010, specifically Title II, the Orderly Liquidation Authority. This law was passed after 2008 to prevent taxpayer-funded bailouts. Instead, it legalized bail-ins. Witaus, it states that a failing financial institution must be recapitalized by its creditors. That means you. The government didn't fix the system. They just changed who pays for the collapse. Yesterday, JP Morgan triggered this clause. They are not stealing your money. They are enforcing a contract you signed but never read. We have seen this movie before. In 2013, in Cyprus, banks failed. Did the government print money? No. They executed a bail-in. Accounts with over 100,000 euros had 47.5% of their money seized overnight. In exchange, the depositors were given bank equity, worthless stocks in the failing bank. People went to sleep rich and woke up poor. That was the test run. That was the experiment. Today, that experiment has gone global. The template developed in Cyprus is now being applied to accounts in New York and London. History is not just repeating, it is escalating. The most common counter-argument is, but I am FDIC insured up to $250,000. Let's look at the math, because math doesn't lie. The FDIC, Federal Deposit Insurance Corporation, has a reserve fund of approximately $120 billion. The U.S. banking system has over $18 trillion in deposits. That is a coverage ratio of less than 1%. If one small bank fails, the FDIC works. But if a giant like JP Morgan fails, or if we see a systemic contagion like we are seeing today, the FDIC is mathematically bankrupt instantly. They cannot insure a system that has collapsed. The insurance policy is a psychological comfort blanket, not a mathematical guarantee. Before they take the money, they freeze it. We are